been a really interesting and promising couple of days from the US and UK perspective, and for very different reasons. If we start in the US on Thursday, we got CPI inflation data. Now, the first thing to note about this is that it's not the Fed's preferred inflation reading. That is the core PCE price index, but it is released 2 weeks before we get that data, and therefore tends to carry a little bit of extra weight as far as markets are concerned. And what we saw from the data yesterday was another beat on both the headline level and the core level. The second month that we've seen a beat on both, which gives people that additional confidence that not only are we heading in the right direction, but we could also be doing that at a more accelerated pace than we would have otherwise thought. We got plenty of bad news on that side last year when inflation was consistently rising faster than thought. So if we can see it going the other way as well, then that will be a really promising development from an economic, inflation and interest rate perspective. As you can see here, CPI headline rose to 3.2%. Now, there was base effects and other things at play here. It was actually expected to rise to 3.3%, but that is still extremely low, not too far from the 2% target. The more promising thing came from the core inflation reading, which fell from 4.8% to 4.7% against expectations of a pause. Now, what's interesting about both of these two figures, the headline number is effectively what the Fed's target is set against. So 2% inflation is what the Fed is trying to achieve, but it's trying to achieve that over the medium term. And a lot of what feeds into the headline inflation number is quite volatile things like energy prices, as we've seen over the course of the last couple of years. And that's why there's such an obsession with core inflation, because this is what tells us effectively how sustainable that headline number is. If headline inflation and core inflation are both running at 2%, that suggests that inflation is going to remain at those levels over the medium term. If headline inflation is running at 2 and core at 6, then that would suggest that is not going to happen and is going to be far more challenging over the medium term. So the fact that core inflation is still high is why interest rates are going to remain high for a little bit longer, even if the headline number falls below 3%. But we've seen some really promising moves over the last few months, particularly at the core level. And yesterday is another example of that. The other piece of data came from the UK. Now, that was this morning. I don't normally put too much weight on the GDP data because the GDP numbers, especially for the UK and Europe, are basically flatlined over the course of the last year. But I think what was really encouraging about this data is that we saw a very strong monthly reading that may have had something to do with the number of days worked. So things like manufacturing and construction were better than anticipated. But it was an easy beat. I mean, we saw 0.5% month-on-month growth above the expectation of 0.2%. The impact on the quarter was that we saw 0.4% quarterly, 0.2% quarterly growth, 0.4% annualized growth, which again is nothing to be celebrated per se, but it does suggest again there is a lot more resilience in the UK economy. And at a time when we are now seeing inflation moving in the right direction, that is seen as a positive thing, because now the general belief is that a recession will be avoided. And part of the reason for that is not only have we seen incredible resilience in the economy over the last year, which we have, but also wages from July are expected to be rising faster than inflation, which means that we are seeing positive wage growth, which should support consumer activity. It could also make getting inflation back to target more difficult because of the resilience in the economy, as we've already seen so far. But we are seeing progress on the inflation side, and that is providing that little bit of comfort. From what it means for the markets, we'll start with the US. In the US, we're expecting interest rates to not rise anymore. There's a strong belief that we are going to see interest rates remain unchanged in September, particularly on the back of that latest inflation report, but it was already largely baked in. And as you can see going forward, the belief is that we will not, or there's very little chance that we'll see any further rate hikes going forward. In the UK, 1, maybe 2 rate hikes are still priced in. So the next rate hike will come likely at the next meeting, although there's an increasing thought process that we may see a pause at the next meeting because of the progress that we have seen. But another rate hike at least is heavily expected now over the course of the next couple of months before we see the end of the tightening cycle, at which point the focus and attention will turn to how much progress we've made on inflation going into the end of the year, because it is expected to fall a lot further over the course of those months. And then when can we expect to realistically see interest rates falling once more, alleviating those pressures on the economy? In terms of what that means for the chart, now we've got the pound dollar chart, and you can see here that we saw a lot of choppiness and volatility in the pound dollar yesterday, but while we saw weakness in the dollar on the back of that inflation data initially, it didn't take long for that to reverse course. That suggests to me that maybe the fact that we're seeing more promising data on the inflation side on a month-by-month basis suggests that maybe it's becoming a little bit more expected, even if it's not built into the forecast, that when we do see a beat, it's not the surprise that it was a month or two ago. So I think that potentially has a role to play within this as well. We've also seen a lot more dollar strength recently. And this inflation number is no game changer. It's not going to bring forward the first rate cut to the first quarter of next year at this point in time, for example. Even if it was a bit of a nice surprise, you always see a bit of choppiness around this number. And then today we've seen the pound actually edge higher against the dollar. And again, I think that's probably a little bit built on that GDP number that we saw this morning. But more broadly, what we've seen is a pair that is continuing to hang around that 55-89 day simple moving average band. Now, we broke above that rising trend line a few weeks ago. And since then, we've consolidated in and around that band. We saw a 38.2% retracement that you can see on the chart yesterday, and it rebounded off that level around 128. But we continued to trade in that moving average band. We last traded in there in May and early June, and it provided a nice buffer of support as well. And what that would ultimately tell me personally is that this could, a break below here could be a very bearish development. Now, I know you could look back at earlier stages of the chart and say it was actually quite choppy through there, but that's when this pair was trading sideways, and I don't think we've seen that. I think we're seeing much more of a trending pattern up or down in this currency pair. So therefore, the breaks of these moving averages are arguably that little bit more significant, but a break below the 55.89 day simple moving average could be a bearish development. It would also take it below that low that we saw previously back at the end of June around 126. So again, break that cycle of higher highs and higher lows as well. So I think that could be a really interesting bearish development if we do see that materialize. If we do see this continue to push higher, then you can see the key fib levels there that stand out for me. A break above these would suggest that we're back into a bullish pattern. But the thing that concerns me in all of that is the break of that ascending trend line that we saw just a couple of weeks ago, which could be a suggestion that the narrative and that the bias in this currency pair has potentially turned south.